You're welcome to another class on strategic business reporting. Tonight, we are going to be looking at IFRS 2 on share-based payment transactions. Share-based payment transactions. So what are we looking at here? So basically, or let me say traditionally, when you buy or sell goods or services, the, the buyer will usually pay with cash immediately or promise to pay later. This is how most transaction is consummated. You want to buy goods or services. The buyer would usually pay with cash immediately. When I say cash, it could be transfer, it could be check, any form of payment, or a promise to pay later. That's how transactions are done. However, in recent times, entities have decided to pay for services received with their equity instruments. So this standard is this standard this standard's objective is to prescribe the accounting treatment of such transactions where entities pay for goods or services with their equity instrument. And that's what we want to look at today. How we account for transactions where entities pay, where the buyer pay for goods or services with their equity instruments. Now, for proper context, right? So where the buyer agrees to settle in cash either immediately or later. It is usually recognized as below. You see, traditionally, where the buyer agrees that, okay, I'll settle in cash, either immediately or later, you know, the way we record it is that the buyer will say he will debit what he has bought. Or if it's a service he has received, whether professional service, whether legal service, whether accounting service, or whether service from an employee itself, can debit staff cost, so, or any other expense. Could even be assets. If it's an asset that he is paying for, he debits whatever it is that he is buying, and he credit bank. That's if he has paid immediately or if he's paying later. Who can tell me what do we credit if you are paying later? Um, so Fashion is here. Where is Moses?
Sir.
How are you now?
I'm fine, sir.
Okay. Since I know you are the only one that will respond, so what do we credit if we are paying later?
If we are paying later, we will credit a liability.
All right.
It will be a liability, sorry. Other
That's correct.
payables.
Other payables. So this is the way it is done conventionally or traditionally, but with share-based payments, where entities wants to settle, not with cash, either now or later. No, they don't want to settle with cash, but they want to settle with their own shares. Okay, so the double entry will look like this. This one will not change because they are buying services. They are buying either expense, whatever it is they are buying the debit. So what changes is this credit. So do you know what they will credit? Their equity. Their equity. That's what they will credit. Equity. And that is what is changing here. So, so basically, what we want to learn here, what we want to learn here is when to recognize this expense and how much or the value that is recognized. Basically, that is what we want to learn. As soon as you're able to get a good hold of that, then we are done with this topic. Okay. Yeah, Fashion, I'm with you.
Yes, sir. I understand the debit part in this share-based payment, but when you are crediting equity instruments, is it not like increasing it since like equity is usually a credit balance also
Yes.
instead of reducing?
Yes, it is increasing it. It's actually increasing it. Because you know that when a company pays with its equity, you are increasing your equity. You will have to issue more shares. You issue more shares, you have more shareholders, so it will increase. We are still going to go into further details there. So all I'm just doing now is just introduction. I'm still trying to give you a context around it, which I believe is properly given now. So all this sequencing, all these that I've mentioned so far, is just to understand where we are coming from, that the way transactions are done normally, but entities are moving towards paying with your shares. They are moving towards that. That exists. And you'll find out later that what you'll be tested in your exam is the common one, the one that's where these type of transactions are common, which is transactions between employer and employee, where the employer promised to give the employees some shares if the employee should work for him for a certain number of years. If the employee agrees to work for the employer for for certain number of years. So that is where it is common. So, and that is where your exams will come from. The other ones are quite straightforward. We are going to look at all of that within the next 1 hour. We'll explain everything to you in a very plain term. Okay, now, first thing I need to mention is the types of share-based payments that we have. How these share-based payments, how they happen. There are three that we need to look at. Number one is equity settled share-based payments. Number two is cash settled share-based payments. Number three is equity or cash settled share-based payments. So these are three that we have. Equity settled, we have cash settled, we have equity or cash. So equity settled share-based payments is a transaction where an entity receives goods or services in exchange for its equity instruments. In exchange for its equity instruments. And when we say equity instruments, is either shares or share options. That is equity instrument. So this is similar to what I've explained so far. What I've explained so far is an entity desires or has shown interest in paying for goods or services received with their equity instrument. That is what we call equity settled share-based payments. Okay, so we are going to learn how to account for that and everything. The next one is cash settled share-based payment. So this one is a transaction when an entity receives goods or services in exchange for cash. In exchange for cash that is based on the share price of the entity. So the second one is cash settled. So this is a transaction where an entity receives goods or services in exchange for cash. So here, they are going to pay cash, but the value of that cash is not based on the value of the goods or services received, but it is based on the share price of the entity. It is based on the movement in the share price it is attached to the share price of the company. So it is still a share-based payment, even though the company is paying with cash. But the value of that cash is based on the share price of the company. Then the last one that we would learn is equity or cash settled or settled share-based payments or cash settled share-based payments. So this one is a transaction where an entity receives goods or services and goods or services, and either the entity or the counterparty has a choice of settlements, that is, either settling in cash or with the equity instrument of the entity. So the last one is equity or cash settled share-based payments, where either the entity or the counterparty has a choice of settlement. So either of them can decide how they want to settle. So we don't know what their decision will be, but it's open to them. They are free to decide how the transaction should be settled. So majorly, these are the three types of share-based payments that we're going to be looking at. Now, we just need to pick each of them and learn how to account for them. Believe me, it is very straightforward. And just hope that it comes out in your exam, and it comes out often. Anyways, so before I go into each of these, there are certain terminologies I really need to clear out. Number one is equity instruments. I think I've mentioned it sparingly. Number two is share options. Number three, I'm going to mention um, share-based payments arrangements. That's number three. Number four, we need to take care of what we call grant dates. Number five, we need to identify what we call exercise dates. Number six, we need to identify what we call intrinsic value. Number seven, we need to understand vesting conditions because we're going to see all this. And finally, you need to understand vests. Vest. Okay, so let me quickly just mention all of this because we're going to meet them. So number one is equity instrument. Equity instrument is shares or share options. Shares or share options. So shares is a unit of ownership in a company. When you have shares in another company, it means you have a unit of ownership in that company. It means you're a shareholder. So when we say a company issued out shares, it means that um, this company is giving shares, is giving ownership interests, is inviting shareholders to its company, right? That is shares. But share options, when you have a share option in a company, what you have in that company is a right to buy the shares of that company. Is a right. So the simple difference between shares and share options is that shares means you're already a shareholder. When you have shares in a company, you're already a shareholder. When you have share options, you are just a potential shareholder. You are not a shareholder yet. You can't get dividend and all of that because you're not a shareholder yet. You are a potential. That's if you decide to exercise that option anyways. So that's a share option. Okay, share option, the holder of this share option, the holder has a right to buy the shares of the entity at a specific price at a specific future date. So usually, before we enter into a share-based payment transaction, there is always a share-based payment arrangement. Okay, so this is an agreement that backs up the share-based payment transactions. This is an agreement that backs up the share-based payment transactions. So there's always an agreement. It's a very solid one. Yeah. So the grant date. Okay, so this is the date of the agreement. So the date where the share-based payment transactions was agreed to by both parties. That's the grant date. The exercise date. This is the date where the counterparty can, can collect, let me put it that way, its shares. Okay, so exercise is the date when he can collect it. Collect it, of course, after he has paid or fulfill all its own obligations, right? That's exercise date. So intrinsic value. In intrinsic value, see, this is the difference. This is the difference between the market price of the shares and the exercise price. Okay. Does this make sense? Should this make sense to you with this way? Not really. So, what does this really mean? That okay, there's a difference between market price and exercise price. Okay, so you see, this exercise price is the price that the counterparty or the seller, okay, would buy those shares in the future. So where a share options is given, where we give a share option that you can buy our shares at a specific price at a future date. That specific price is exercise price. That specific future date is exercise date. So the price you can buy those shares for is exercise price. When you compare it with the market price, okay, the difference is the intrinsic value. Usually, you find out that the exercise price will usually be lower, be much lower, and such a way that if the counterparty should buy those shares at that price and it decides to flip it or sell it immediately, it will make a huge gain. It will make a huge profit. And this is really the value of this type of transaction. Because one should be wondering, when I started the introduction, the entities have decided to start paying with their shares. I mean, they can decide, but it is left for the seller to agree. But they are agreeing. Why? Because of the intrinsic value involved. And you find out that most of the companies that consummate or enter in this type of agreement are companies whose shares are valuable, that nobody will refuse them. Their shares are valuable, and people are really interested in having their shares. And that's why they can enter into this type of transaction. So they will tell you that I can't pay you cash, but I can give you my shares. but you will pay just 2 naira for these shares. I can guarantee you that in the next 2 years, my market price will be 10 naira. So whoever is holding those options can easily make a gain of 8 naira. It looks attractive. And that's what we call intrinsic value. And that's what we call intrinsic value. So again, the exercise price is the price the counterparty will pay, is the price the person that is holding the option will pay to buy those shares. Okay? Is the price that will be paid to buy those shares at the exercise dates. So it's just like I'm giving you shares in my company. You offered me a service and I said, okay, I'm giving you a share option. I'm not giving you my shares now, but I'm giving you a share option, which means that you can buy my shares in the future at a specific price. Okay, so that specific price you buy it in the future is the exercise price. We expect it to be much lower. You will expect it to be much lower than the market price. Because that's the only reason why anybody will want to agree to this type of transaction. Because why would I want to collect your shares? Please give me my money. I would rather collect my money and go to the open market and buy your shares now. Yes, now. Why are you forcing me to buy collect your shares? I've offered you money. Please give me I've offered you service. Please give me my money. So I watched a documentary of Facebook when those guys started, uh, around 2004, so 2005 or thereabouts. I mean, this was a documentary. So there's this guy, guy is a millionaire now, dollars. So he helped Facebook paint their office, the whole of their office. So Mark offered him to share options. I don't have money, I don't have cash now. We're a startup, you're managing cash flow, but I can give you share options. I can give you shares. He even gave him an outright shares in my company that you can hold it, right? But holding it in the sense that you cannot sell it until we go public. So, I mean, the guy, I think he knows that he doesn't do well with cash flow. If he gets money, he just spends it anyhow. So he agreed that, okay, no wahala. He just accepted. Ordinarily, he knows he will not accept. He doesn't know why he accepted. Because I want $10,000. So the guy was stating how he became a millionaire in dollars because of that transaction. Because that same number of shares became so valuable that I mean it went beyond his wildest imagination. And that is what we call intrinsic value. That's the inherent value in this type of transaction. That is why anyone will accept to opt for a share-based payment instead of an immediate receipt of cash. I hope I've been able to drive home the point. So, like I mentioned earlier, you would see that this type of transaction is common, much common with for directors' compensation or employees' compensation. It's common there, and that's where your exam is going to come from, not the scenario I gave you about Facebook and a random guy. So, yes, it exists also, but the accounting for that is a little straightforward, especially if they are giving outright shares. But you find it much common in transactions between employer and employee. So, there's usually something we call vesting conditions, right? So we are saying that yes, we are giving you a right to buy our shares in the future, but there will be conditions to that. Okay. So you see, these conditions are usually service conditions or performance conditions. So when we say service condition is where the employee will work with the entity for a certain number of years before it can be entitled to the shares. That before you can get these shares, you need to work for us for certain number of years. That's service conditions. And there is performance conditions, is where the employee is required to meet certain performance targets or metrics, either sales targets or profit targets or volume targets. That's performance conditions. So these are usually the conditions that are attached to share options or share-based payment transactions generally. So as soon as these conditions are met, then the options will vest. So vesting means this is where the counterparty is now entitled, meaning he has delivered his own deals. He has worked hard. It has now vested. So this is where the counterparty is now entitled to the shares. He's entitled to it. He can now execute that option and collect his shares. That is where it has vest. So these are terminologies that we are going to be mentioning all through this class. I'll be mentioning a lot of share options, okay, and there are other ones like share appreciation rights or whatever it is the name the examiner wish to call them. Also, we'll be mentioning grant dates a lot of times. I'm mentioning grant dates, which is the date the agreement was signed. We mentioned this quite a lot also. I would also be mentioning exercise price and the dates. And I will also mention intrinsic value quite a number of times. Oh, of course, in almost all our questions, there will always be vesting conditions. There will always be vesting conditions. So all these are the terminologies you need to get familiar with. Now, let's start with equity settled share-based payments. Now, in fact, because they are recognized the same way, let me start with recognition before equity settled, recognition of share-based payment generally. And we have share-based payments. So when are they recognized? So all these three types that I've mentioned, okay, all of them, they are recognized when the entity receives goods or services. So as soon as an entity has received goods or services, then we can recognize it in our books. So for equity settled now, for equity settled share-based payments, we'll recognize it in our book by a debit to, like I've told you already, either purchases or expenses, and a credit to equity. Okay, usually equity or equity reserves. So you'll see me using equity reserves often because what is popular is share options. So hardly would you find the examiner give you this one where you just credit equity, because that one is very straightforward. You will see why very soon. So you will see the examiner giving you share options where um, what the counterparty has or holds is a share options. In that case, we cannot credit equity. What we would credit is equity reserve because it is not equity yet. If a company issues share options, you cannot credit equity because you have not issued shares. The counterparty is not a shareholder yet with holding of share options. It's not a shareholder yet, so you cannot credit equity. We can only credit equity reserves until it is when it is now shares, when it has vest. That is when you can then credit equity, specifically share capital. However, if it is cash settled share-based payment, remember, for cash settled, the entity is giving cash, but the value is based on the share price of the company. So again, the company, and again, you need to note something that everything I'm going to teach you in IFRS 2 is from the perspective of the seller. Sorry, from the perspective of the buyer, the person that is paying. Okay. And usually it will be an employer, the company. We are not accounting for the person that is selling. That one is IFRS 15 that I just finished teaching you. That one is based on IFRS 15 recognition. Okay. So whether is whatever it is, that is the transaction price. We already learned in IFRS 15 that it can be non-cash consideration. So this is an example of where the transaction price is a non-cash consideration. So we're not looking at that. We are looking at the buyer now, the person giving the shares or share option. So where a promise to give cash, whose value is based on the share price of the company. And again, we are still going to debit purchases or expenses or assets, depending on what we are buying. In this case, we are going to credit liability. We are crediting liability because we have an obligation to deliver cash. So here we are paying cash. Here we are paying cash. So for that reason, we are going to be crediting liability. We are going to be crediting liability and not equity. Yeah, fashion it on.
Why not credit bank since we are paying cash?
Because we have not paid. The person has to meet some conditions. There are always vesting conditions. We have not paid the person. We are not paying out Friday.
Oh, thank you, sir.
Yeah. Okay. The last one is equity or cash settled. Equity or cash settled. So for this one, equity or So here also, nothing is changing, but is either you are crediting that. So this one is usually a compound instrument that we're going to have to credit equity and liability. We have to credit equity and liability. So we're still going to learn about compound instruments in this class. So we will see how that is treated. So this is the general way of recognizing that. So now the next thing is how much. So it now depends on the types. So let me start with measurement of equity settled share-based payments. So for measurement, ordinarily it should be straightforward, right? But this is the challenge. So we have two items here. One is that we have goods or services that the buyer or the company is receiving on one side. And on the other hand, also, we have shares that the company is giving or share option that the company is giving out. So, and it therefore means that we have two different values in the same transaction. It's different from when you go and buy a car. You say how much? You say 10 million. Then that means you know that what you have to pay is 10 million. But you just go and buy a car. The guy said 10 million. And you said, okay, I will give you 10,000 shares. I will give you 10,000 shares. But the guy said, my car is 10 million. You said, I'll give you 10,000 shares. So if they bring the transaction to you, are you going to use 10 million? Or are you going to use the value of 10,000 shares? That's the challenge here. That's the challenge here. So what does the standard say? IFRS 2 says that this is measured at the value of the goods or services. Simple. So you use 10 million. You use 10 million. You use the value of the goods or services. However, however, where the counterparty, where the counterparty is an employee, then it's difficult to get the value of the services. It is therefore difficult or impossible, not even difficult alone, it's impossible to derive the value of the goods or services. Hence, it will be measured at the value of the share options at the grant date. It will be valued, it will be measured at the value of the share options at the grant date. So this is where the counterparty is an employee. So you'll agree with me that for an employee, this type of transaction can only be part of their existing compensation because employees normally get monthly wage or salaries. So in addition to that, you now say, okay, we want to give you guys share options if you work with us for 5 years, something like that. So in that case, you cannot measure this at the value of the service the employee is rendering to you because you cannot really know the value of that service. You cannot really know the value of that service. So the only way we can measure this is to then use the value of the share options at the ground date because that's readily available. That is readily available. Okay, so as far as the measurement is concerned, this is how it is done. Okay, still on measurements. Additionally, services are provided either at a point in time or over time. Remember, we talked about this in IFRS. So, where services are delivered at a point in time, the entity will recognize the service as an expense or assets immediately, and it ends there. But where services are delivered over time, the entity will recognize the service over time. It's just like the example of employees that I gave you, that the employee needs to work for 5 years. Okay. So in that case, when are we going to recognize the expense in our books? Is it after 5 years or at the beginning of the 5 years or when? It's not at the beginning, it's not at the end alone, it's over the 5 years. It's over the 5 years. And this is in line with the accrual concepts. So believe me, everything we want to discuss under this this standard, everything is focused around this. Okay, is focused around this. So normally you will not find them asking you this because it's so straightforward. And this can only happen where what the employer or the entity is giving is shares, that he just gives shares for goods or services he has received, that I'm giving you shares. The counterparty becomes a shareholder immediately. To account for that is so straightforward. You just debit bank and I say debit bank. You debit services, you credit equity or share capital. And that is, it ends there. You will not find that. I've never seen that. The one you see often in your exam is where the counterparty, usually an employee, would have to work for the company for many years before it can get those shares or before the option can vest. In that case, a lot of people, in fact, the way it was done was that people will not even recognize the transaction in the books at all until when the company wants to give shares, until when the employee has met the condition and they want to issue out shares to the employee. That's when they will not put it in the books. That is wrong. That is wrong because it shows that you are not recognizing economic transactions. Employee has been working. You need to have been recognizing expense at the end of every year. So that's the focus, really. Now, see, IFRS 2 requires that that an equity settled share-based payment should be measured at the reporting dates based on the number of employees, based on the estimates of the number of employees that is expected to vest. So this is very, 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 very important, which I would explain better with an example. So let's say entity A issues 500 options to 20 employees on 1st January 2024. The employees must work till 31st December 2025 for the options to vest. So how is this accounted for? So how do you account for this? Okay, it's not complete. Remember I told you that it's usually measured at the value of the option and the grant date. So they give us the value of the option is 3 naira on 1st January 2024. So how do you account for this? Okay, so for this one now, this is what we're saying. So first, I need to get the value of the option. The value of the option is how many options? 500 options. How many employees? 20 employees. What's the value of the options of each option? It's 3 naira. So how much is that? 10,000. Is that 30,000?
Yes, sir.
30,000. So at the end of year one, which is at 31st December 2024, we'll debit staff costs, but it's part of employee remuneration with 30,000 divided by what's the vesting period? They're supposed to work for how many years?
5 years.
From
Yes.
2024 to 2025. That's 2 years. 2024 and 2025. That's 2 years. So at the end of year one, we cannot recognize the whole of this 30,000 because this 30,000 is only obtainable when you have worked for 2 years. So as soon as you have worked for 1 year, we'll recognize it's like dividing by, or it's like this is similar to we are multiplying by 1/2, something like that. If it is 3 years, you do 1/3, something like that. So, and that's how much? 15,000. And do you know what you credit? Equity reserve with the same amount. with the same amount. And at 31st December 2024, we'll also debit staff costs and credit equity reserve. Because equity reserve is cumulative, it's a cumulative figure. So we expect the balance on your equity reserve to now be 2/2. Okay, which is how much? Times 2/2 is equivalent to, that's 30,000. So we usually do this in a cumulative way. So this 30,000 is still this value of the option, but this is the second year, so 2/2. What goes to staff costs is the increase in the reserve. So this 30,000 is capturing year one and year two together. So what goes to P&L as an expense is just year one, which is this minus this. So this is similar to you are debiting this, and you are also crediting 15,000 at the same time. Okay, it's similar, but the balance in the equity reserve is this. So usually you find me calculating this first, the balance in the equity reserve, because that really tells me where we are. So since this is the vesting date now, so that means the balance is now 30K. So which is the exercise date? So at the exercise date now, when they are exercising this option, when they pay for it, I can easily debit bank and credit equity reserve and credit equity reserve. So because I will collect money from them, then one way or the other, we'll find a way to transfer some amount to share capital also, because we're going to issue shares to them as well. So I will show you how this usually works out. So this is the list of our problem. And this is the easiest one you can have. And nobody's going to give you something this easy in the exam. Nobody. Now, let me show you what you will likely find in the exam. Let me use that scenario 2. So let's say they work till 2006, no, 7, so that you understand it. So they now say that in December 2024, in December 2024, it is estimated that it is estimated that that 5 employees will leave over the period or over the 3 years. Let me put it that way. Because here we have a 3-year vesting period, 24, 25, 26, 27. It's not 3 years, so it's 4 years. Over the 4 years. And in December 25, 5 two employees, leave, and it is estimated that 10 employees will leave over the 4 years. Sorry, this is 25. Now said again, in December 26, 3 employees leave, and it is estimated that 12 employees no, let me not do that now. And it is estimated that additional 4 will leave in 2027. In December 2027, no employees left. So how do you account for the above transaction? So if you're able to understand this, then you're fine. You're very fine. If you don't understand this, then you'll not start struggling and struggling and struggling until maybe you probably get it along the line. So just try and your best and see and get it and move on. Because everything is really not more than this is the part where you find the examiner flexing. So the first one, we account for this at the end of every year. At the end of the first year, which is 2024, first, the examiner told me that they estimated that 5 employees will leave over the 4 years. That's their estimate. And that is how equity settled is measured. Is measured based on the estimates of the number of employees that will vest. What that means is that at the end of every year, we need to have an idea of how many people will not leave the company. And why do we need to have that idea? Because those are the people that we are actually going to incur expense on. Those are the people we are going to give shares to. Those are the people whose options would be exercised. So we always want to do it in such a way that at the end of every year, we are only accounting for those people. We are only taking those people into consideration. Okay, we don't want to take people that would not be in the company, that will not vest. We don't want to be recognizing expense in respect of those ones because those ones will not be in the company. Why are we stressing ourselves? So since the examiner told me that they are estimating that 5 employees will leave, and they have to estimate because um I need to know. Yes, I mean this is 2024, but I need to know how many of the employees, how many of these 20 employees will actually vest. I need to have an idea today. So the only way I can do that is to estimate. So the examiner will give you the estimation. So of what will happen at the end. So or over the period. So in this case, they have given me very straightforward. That means what I will recognize in year one will not be based, these 100 options will not be calculated on 20 employees because I already know that 5 of them will not vest. So what's the point of recognizing expense for them? Because if you don't work for 4 years, you're not going to get options. You're not going to get it. So there's no point recognizing any option for you. So in this case, I'll recognize for how many employees? 15 employees. These are the people that we estimate will vest. So multiply by the fair value of the option at the grant date, which is 3 naira. And how much is this? Somebody should give me the figure.
22,500.
So
22,500.
26.
22,500.
Yeah, this is what I wrote. So what am I recognizing in year one? I cannot recognize this entire amount. This entire amount relates to that's the value of the option at the vesting date. So how much of this value will I recognize in year one? I'll multiply it by what?
Over 4.
1/4. So I'll have staff costs and equity reserve. So how much is going to staff costs?
5,625.
Like that, like that. Okay, that's year one. In year two, now, they said 2 employees leave, and it is estimated that 10 employees will leave over the 4 years. So who can tell me how many employees will I or should I provide for? How many employees, in fact, let me put it this way. What's the estimate of the employees that will get these options at the vesting date, which is 2027, based on this statement? You can tell me.
8.
Okay, it's 10. It's 10. Why? Because it depends on how it is structured anyway. They said, yes, 2 people have actually left at the end of this year. However, then I estimated that 10 employees will leave over the 4 years. Okay. So this is what I have to work with because these 2 has been captured by this 10. So because of the 2 that left this year, that was why they estimated that, okay, let's estimate that 10 will live over the 4 years in such a way that at the end of 2007, we're estimating that only 10 will remain out of the 20, since 10 will live over the 4 years, and which is what I want to work with. So you'll see that at the end of every year, the examiner is giving you all sorts of variations that you need to work with, which is quite straightforward. So at any point in time, you just need to ask ourselves, okay, based on this information given to me, how many people will not go? Or what's the estimate of total departure? You can put it that way. And you need to ask yourself, because it's estimate. There's no way we can know people that will live in the future. We have to make estimates. Okay. Sometimes they will give you estimate of the whole period, meaning they have factored in all the actuals. Like this 10 now has already factored in the 2 that left. Okay. And that's why it is given over the entire period. So this estimate has captured these 2 that left already. Okay. So in that case, then you just set your mind on, okay, how many people are really going to be left at the vesting date? Because I don't want to be accounting for, I need to just make that estimate. It might change, as you can see. You see, in year one, they say 5 will live over the 4 years. Now the estimate has changed again. It's not 5 anymore, it's now 10. No problem. We don't have any problem with that in accounting. Let it change. It is not a problem for us at all. We'll just continue to change our amounts. So in this case now, how much first? You see, we always determine what goes to reserve, the balance in your reserve. That's how we work it out. So these options will be given to just 10 employees. It will be based on 10 because we have estimated that 10 will leave over the 4 years. Okay, because 2 has already left this year. So we are estimating that, okay, the total departure over the entire period is 10. So it will only remain 10, multiplied by 3. This one does not change. It's always measured at the value of the option at the grant date. It's always measured at that at the grant date. So how much would this give you?
15,000.
Again?
15,000.
15,000. Okay. So what goes to my equity reserve is the cumulative now for year one and year two. So how much is this?
5.
Eh?
7.5.
7.5. Okay. 7,500. That's the balance in my equity reserve. So how much are we expensing? Is us this?
1,875.
Yeah. Like this, Abi?
Yeah. Yes, sir.
Okay. In the third year, December 2026, they said 3 employees leave, and it is estimated that additional 4 will leave in 2020. Sorry, this is 2027. Since 2026, 3 leave already. So it's estimated that additional 4 will leave in 2024, in 2027. So now, based on these estimates and information given to me now, how many employees are we providing for? What I mean is, how many people would not leave at 2027? Or how many people will remain at the end of 2027?
That would be 20 minus 7, 13.
14.
How did you, the person that got 13, person that got 14, how did you get that?
We have 20 people, and they're
Uh-huh.
saying that 3 people have left, and additional 4 will leave. So that's 3 plus 4. That's 7 people are going to leave the company as over the period. So that's why I said 20 minus 7 is 13.
Yeah, okay, good idea, but that's not right. Because it's not 7 that is living over the period. You have really considered 2026 and 2027.
Okay,
Over
sir.
the period is not 2026 and 2027. It starts from 2024. Okay, I'm with you.
Okay, sir. So why I actually said this 14 is because in year 2025, they estimated that 10 persons are going to leave. So it was just 2 people that left. Now in 2026, we are also going to estimate that it's 4 persons that are going to leave, which we already know that 3 employees, it was just 3 employees that left, although we'll make provision for 4 persons that will be leaving in 2026. That's why I said 14.
No. You are doing woo to the answer. When they said 4 will leave in 2027, you're saying we should make provision for 4 in 2026. Why? So,
Sorry, I didn't see that.
So is it like 20 minus 2 minus 3 and minus 4?
Correct. Correct. That was what I was going to write. Because what is in my mind, what is in the standard's mind, what an accountant should do at each end is to ask how many employees should we provide for? How many employees will not leave at the end of 2027? Remember that we are giving these options to people in 2027. It's because of accrual concept that we have to recognize it every year or over the period. So whatever it is we are recognizing as expense, we want it to reflect the options we will actually give them in the future or at the vesting date. So even though we can't know that for sure, which is why we can estimate for the ones we don't know for sure. Like in year one now, they just estimated, fine, that 5 people will leave over the entire period, which means that only 15 will be left in 2027. Yes, that's what I'm concerned about, though. The vesting dates. My accounting for each year is based on what the happening investing there, which is why I painted this one in bold. That IFRS still requires that equity settled share-based payment should be measured at the reporting date based on the estimates of the number of employees that is expected to vest. That's the secret to all of this. So that's why in year one, I only provided for 15 because based on the information I have in 2024, 5 will live over the 4 years. But in 2025, everything changed because 2 people left. Then I estimated that, okay, it's 10 people that will live over the 4 years. That means I only provided for just 10 remaining. There is only 10 that will remain. It's okay, it's changing, no problem. Now in 2026, it has changed again because 3 people left now. They now say that, okay, additional 4 will leave. So fine. Since this one is clear, the estimate they gave me is just the estimate of 2027 alone. I then need to ask myself, I need the total that has left so that I can know who is remaining in 2027. I know that in 2024, nobody left. In 2025, 2 people left. In 2026, 3 people left. And we are estimating, because there is no way I can know the people that will live in 2027 now. I can only estimate that 4 people will live in 2027. So you see, the way this is structured is different from the way the examiner can structure it in different ways. It doesn't matter. Just look in this case now, you see that when they were going to estimate here, they estimated for all the period, which is why I didn't consider the people that actually left, because this 10 has already captured it. It has captured all the period. But yeah, when they were going to estimate, they didn't estimate for all the period though. They only estimate for the future. The additional 4 will leave in 2027. So, which is why I have to consider, okay, since I need people that will remain in 2027, I need to know, okay, which people have left in the past, has actually left in the past. Then I can then add the estimate for the future, which is what we are doing. So we have 20 total, 2 left in 2025,
Hello,
3 in
sir.
2026, and 4 in 2027.
Hello,
Yes, my
sir.
brother. Yes, sir.
Please, this in 2024 December, what of the 5 employees that left? Is it not inclusive?
It's an estimate. And in this 2024 December, they estimated that 5 will leave over the 4 years. Over the 4 years. So it's not like 5 left in 2024. They just estimated. So apparently, nobody left. Nobody actually left. we just estimated that, okay, 5 employees will leave for whatever reason they estimated over the 4 years. So we worked with the estimates. You have to work with the estimates. So we said, okay, 15 is remaining. Okay, so these 5 did not actually leave. It's just an estimate. Which can change, as you can see. In 2025, they changed the estimate to 10. We then worked with 10. Amalola, I don't understand your question. Is it because it is the year preceding the year of vesting? It's not, that is not the reason. It's not because of that.
What I'm trying to ask is because my background is quite noisy. What I'm trying to ask is the reason why we are removing 20, removing those who have left from 20, is it because it's the year preceding the year that they will vest? I mean, that's 2027.
No.
Is that why we are considering all of those who have left and the estimated, the numbers of them that was estimated for 2026?
That's not the reason. That's far from the reason. The reason is because of the way this is structured. They gave us estimates that additional 4 will leave in 2024. They only give us estimates for next year. If they had given us the way they have been giving us, if they had said, and it is estimated that 4 will leave over the 4 years, I will only consider 4, meaning 16 will remain. Meaning 16. They're estimating that 4 will live over the 4 years, if that's what they have said. 16. But they said additional 4 will live in 2027, next year alone. So they're estimating for next year alone. And I need to know how many people, the estimate of total departure. I need to only know, my concern is, in your mélòó, how many people would be there in 2027? So it depends on each year, the estimate, how the examiner gives you the estimate. So for that reason, I said, okay, I have a total of 20. I know that 4 will leave, estimates of 4 will leave next year. So I need to then consider how many have actually left before. 2, nobody left in 2024. 2 left in 2025, 3 left in 2026, and 4 is estimated to leave next year. It's not hard at all, except you just want to make it hard. It's not hard to determine how many people will not leave. It's not hard. So give me, what's the figure? So this is the, whatever is the balance is the people that will not leave.
16,500.
Again, we do cumulative.
16,500, yes, divide by 12,375.
That's what you got.
Yes, sir.
So how much goes to your P&L?
$4,875.
Which is the difference between this and this. This minus this. Now, in December 2027, I'm told that no employees left. So how many people are remaining now? Okay. So how many people are remaining now? Because this is the vesting date. Lola, how many people are remaining now? How many people are actually going to vest? Chidima.
I think
11.
15.
15.
11.
Who said
Ah,
15? Who
I
said
said
15?
15.
Lola,
Yes,
you said 15.
yes.
I'm coming to meet you.
Away.
Who said 11?
Mustafa.
Mustafa, you said 11.
Yes, sir.
Coming to meet you. You want to say something, Fashion?
No, don't come and miss me. I'm okay.
Eh, I need you to tell me something. Echo, I've not heard your voice today. What's happening?
I'm just observing.
You're just observing, but are you
Yes,
getting what we are talking about? Are you getting
yes,
it?
I'm getting it. It's just that when you go back up, sorry, I'm taking you far. Go up. You just
Okay.
scroll up to the uh still go. Still go. There is a place this place at where you wrote at 31st December. That's second 31st December. 2024. Is this supposed to be 2024 or 2025?
It should be 2025. Oh.
Yes. Thank you.
Yeah, yeah.
So
All
I
right.
think
Thank
Okay.
you.
Omolola is correct too.
Eh, I agree with
Yes,
Amala.
because 20 people, 22 people have left. 20 minus 2 minus 3, that's 5. The 4 did not come into effect in 2027. So that's 20, just 20 minus 2 minus 3, that's 15.
Okay. I need one more person to round up.
15 is correct too.
Now you're changing your mouth.
No, so I said 15 before. It's just that she said it while I said it too. So it was as if, you know.
Yeah, I agree with that 15 actually.
I think I agree with that too.
You are doing Ujo. Okay, 15 is correct, actually. 15 is the right answer because the people that actually left all over the 4 years are actually five. Two in 2025 and three in 2026. Nobody left in 2020. All these other ones are just estimates. So estimate cannot apply parts. In 2027, which is the vesting date, you will actually then know who actually left over the period. Unlike the previous where you are still guessing, when you're still guessing, when you're still estimating. But now we would know. So that's 500 times 15 times 3. So how much is that?
15,000.
So this is like times 4/4, something like that. So minus this, what would that give you?
2625.
Okay.
I got 22,500 though. 500 times 15 times 3.
Please, I have a question.
Okay, Amalala. Oh, yeah,
Okay, so
sorry,
please,
sorry,
for
Amalala.
clarity's
Wait first, Amalala. So what's the difference between these two? 22.5 minus 12,375.
10,
10,125.
10,125.
Okay. Oh yeah, Amalala, go ahead.
Please, sorry to take you back. I
No
still
problem.
need clarity.
Okay.
The rationale behind us deducting the um equity reserve that we get here minus the first one. That place is not clear. I didn't just want
Ah,
to cram it.
okay. I get what you're saying. So, in the first year, debiting this, crediting that. The first year was straightforward because this just divided it by 4. So representing for 1 year alone. In the second year, we did cumulative. This 2/4 means whatever value you get. You see, first, this 15,000 is the value for the entire 4 years. That's the value of the option. So the way it's done is we usually get the value of reserves first. So we do 2/4. So whatever it is we get, which is this, is for year 1 and year 2. That's the value. That's the value of the options the employees has worked for to date. That's what is in the reserve. In such a way that if the employee decide that, or if the company says that we want to give you what we have worked for till date, is the value is 75. So there is the cumulative. But what they have worked for this year alone, is the increase in the reserve, which is this minus this. Because this 75 already includes this. This 75 encompasses this 5625. So to know the one that relates to this year, because staff cost goes to P&L, and P&L relates to for the year. We are looking at for the year alone. So again, for this one, when we got the value, which is 16.5, we also got the cumulative for 3 years, 3/4, because this is the third year. So which gave us 12,375. So this 12,375 is the value for the 3 years. Is the value for the 3 years. So to know what we are going to expense, what relates to the year, because this 12,375 encompasses this value, these 2 years, this 75 already. So the increase is what goes to P&L. And the same thing applies for the 4th year also. This is the 4 years, the value of the 4 years. What goes to P&L is for the year alone. So it's the increase between these two that goes to P&L for the year. So that's how it works. That's why we are looking at the increment, because of we are calculating cumulatively. Is that clear?
Yes, thank you.
Now, this question, it says on 4 January 2001, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employee working for the entity until 31st December 2003. The fair value of each share option is 20 naira. During 2021, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. During 2022, a further 25 employees leave, and the entity now estimates that 25% of its employees will leave during the 3-year period. During 2003, a further 10 employees leave. Required. Calculate the remuneration expense that would be recognized in respect of the share-based payment transactions for each of the 3 years. Okay. So what do we have here? So here now, the grant date here is 2001. The exercise date is 2003. That means the vesting period is 3 years. You have to figure that out first. Where is grant date? This is a grant date. This is the exercise date. So we are looking at 1, 2, 3, 3 years. So we are giving each of our employees 100 share options. We have 400 employees. And the fair value of each option at the grant date is 20 naira. So we're going to measure those options with 20 naira. Those are the fair value at the grant date. So also, then at the end of each year, they were then giving us some estimates. So first, in December 2001, I'm giving 100 options, Abi. Now, based on these estimates now, how many employees will not leave? Will not leave by the end of 2003, which is the vesting date, how many employees will not leave? Of course, you know that it's not possible for us to know that with certainty. We are not God. So we can only estimate. So let me put it as, what's the estimate of employees that will not leave, that will remain in this company?
That's
Who can tell me?
80% of 400.
That's correct.
320.
320. That's correct. That's correct. Because 20 employees leave, and the entity estimate that 20% of the employees will leave during the 3-year period. So you see, this estimate has already captured, it has already encompassed this 20 that actually left in 2021, because this estimate is over the entire period from year 1 to year 3. They have given us the estimate that 20% will leave. Since what I need is people that will not leave over the period, that's 80% of our entire workforce. That's 80% of our entire workforce. Some people will say we'll go and do 80% of 380 at that. Should be 20 has left. Then it should be 40 minus 20 now. No. They say 20% of the employees, all of them, is estimating. So 80% of 400. So you're absolutely correct. What's the fair value of the option at the grant dates? That's 20. So usually we debit staff costs and credit equity reserve. So how much is this?
It's 2,000. Sorry.
Six hundred and
640.
40,000.
Again?
640,000.
Okay, so how much are we recognizing in year 1 now?
213,333.
Don't forget to do 1/3. Oh. So how much is this? You said 213,
Yes,
333,
333.
213, 333. That's correct. Now, let's move to 2002. Let's move to 2002. So in 2002, we have 100 share options. So based on estimate of 2002, how many employees will not leave at the vesting date or at the end of 2003? What's the estimate of employees that will not leave?
That's 400 times 75%.
That's correct. It is absolutely correct. Absolutely correct. So yes, even though a further 25 left again, but the estimate of 25% is for over the period, over the 3 years period. So this that 25% has already encompassed all the living actual. So they give us estimate for over the 3 years. So since they are saying 25% will leave over the 3 years, that means 25% will not leave of our entire employees. So multiplied by 20. Yeah, Mustafa.
Sir, I'm of the opinion that it should be 380 25 of three, because in year one, 20 employees have actually left.
Yeah. So yeah,
And
there's always that confusion, but we need to follow up with this question. You say 25% of its employees, of your entire employees. So not the remaining employees.
that means the 25% covered the 25 employees and the 20 that had left before.
Yes. Including the people that will live in the future, sir. Including the ones that will live in the future. So how much is this?
600,000.
Cumulative, we do 2/3.
400,000 for the equity reserve. Then
How much?
186. 667.
So December 2003, a further 10 employees leave. Okay. I think this one should be straightforward. So in 2003, what is remaining? Who is remaining?
That is 400 minus 20
Right.
minus 25 minus 10.
Correct. That's correct.
Sorry, please, for 2002, how did we get the staff cost?
It's 400 minus this. It's 400
Sorry, I
minus.
didn't get it. Sir, please, how did you get the staff cost to be 186,667?
It's 400 minus 213. This minus
400 400 minus 200, that should be 200 now.
I'm not sure who has been paying attention in this class though, because
I'm paying attention.
I've over
Yeah,
explained
my
this.
location is not managed.
No? Okay. So I mean, maybe because your network or something. So what goes to staff costs is the increase in the reserve. So this 186,667, we did 400,000 minus 213,333. And if you look at it, this year too, the way we got it is 600 times 2/3. This is, we are trying to get the value of the option till date, as at till date, meaning cumulatively for year 1 and year 2. That's what this 400,000 represents. This is the reserve. This is what the employees is due to as at the end of 2002. So it's the cumulative. So this 213 reserve as at last year is inside this 400. So for me to know the expense for this year alone, what they have worked for this year, it's just for me to look at the increase in the reserve. It's increased from this to this. So if you get the difference, it should give you this, except if it's not giving you this. But that's how we got it, and that's why we have been getting it
Thank you
from.
very much. I'm fine.
Okay, good. So we were in 2003. We said a further 10 employees leave. So we're able to figure out that, okay, this is the vesting dates. We can then know the actuals, people that actually left. So which will be the 100 options multiplied by how many employees do we have? 400. How many left in year one? 20. 20 actually left in year one. No need for estimates. How many left in year two? 25. 25 left in year two. How many left in year three? 10. So 10 left in year three. So times this. So how much are we looking at?
690.
690. Again, we'll do cumulative times 3 over 3. That will be 690. How much goes to P&L is 690 minus 400. That gives us 290. What's time? One more. Time's a lot. Let me see. See our sustainability report. No, we have not done sustainability reporting since. So it's 10%. Just try and teach it next. Hey, can we do one more question before we go? Let me see if I can. Yeah, let's just solve a final one, then we'll go. Come in.
Sir, please, while we are waiting for you to take us through the next question, I want to find out, have we done this in IAS 41 in this diet so far? Because I know I skipped one Sunday afternoon class.
No, I've not done IS 41, and I don't plan doing it.
Okay.
Because they never ask it. I'll not be teaching what they don't ask.
All right, sir.
Yeah. And if they ask it, leave it, don't do it, do another one. Okay. Let's solve this one then. We can go. So it says J and B granted 200 options on its 1 era ordinary shares to each of its 800 employees on 4th January 2001. Each grant is conditional upon the employees being employed by J and B until 31st December 2003. J and B estimated at 4th January 2001 that the fair value of each option was 4 naira. Approximately 50 employees will leave during 2001, 40 during 2002, and 30 during 2003, thereby forfeiting their rights to receive the options. The departure were expected to be evenly spread within each year. The exercise price of the options was 1.50 kobo, and the market value of a J&B shares on 4th January 2001 was 3 naira. In the event, only 40 employees left 2001, and the estimate of total departure was revised down to 95 at 24th December 2001, 20 during 2002, and the estimate of total departure was revised to 70 at 34th December 2002, and none during 2003. Spread evenly during each year. Required. The directors of J&B have asked you to illustrate how the scheme is accounted for under IFRS 2. Show the double entries for the chart to P&L for employee service over the 3 years and for the share issue. Assuming all employees entitled to benefit from the scheme exercise their rights, and the shares were issued on 31st December 2003. Okay, quite long, but let's pick out the important things there. So first is we are giving 200 options. This is the nominal value of the shares. We have 800 employees. We are giving them these options on this date. That means this date is the grant date. So each grant is conditional upon the employees being employed by J&B until 31st December 2003. So that's for how many years? That's 3 years, 1, 2, 3. So 31st December 2003 therefore becomes the vesting date. We also told that J&B estimated at 1st January 2001 that the fair value of each option was 4 naira. So this is the fair value of the option at the grant date, because these are estimates at this date. They also told us that approximately 50 employees will leave during 2001, 40 during 2002, 30 during 2003, thereby forfeiting their right to receive options. The departure were expected to be evenly spread within each year. So all of this is irrelevant for this question, because estimates are not made, is not supposed to be made at the beginning of the year. It's supposed to be made at the end of each year. Okay. Yes, they can make estimates, but they need to also confirm the estimate at the end of the year. So we cannot work with this yet until it is confirmed at the end of the year. So we're given the exercise price. This is the price they will buy those shares at the vesting date. And also we're given the market value of the shares at 3 naira. We don't need this one for anything, really. We don't need it for anything per se like that. And I said in the event, meaning at the end of the year, in the event, only 40 left during 2001. And the estimate of total departure was revised down to 95 at 31st December 2001. So which is different from the estimate they made here. So we go with this. 20 left during 2002, and total departure is revised to 70 at 2002 and none during 2003. So very easy question. Very easy question. So at the end of 2001, first, 4th December 2001, I'll have staff cost, equity reserve. So we are given how many options? 200 options. So based on these estimates, this is one I'm working with. In 2001 now, how many people will not leave as at the end of 2003 based on these estimates in 2001? There are only 40 leave, and we now estimated the total departure was revised down to 95 as at 2001. So how many people is estimated not to leave?
5%.
5. Níbo lẹ ti rí ẹ̀?
705.
705. That's 800 minus 95. Because the estimate of total departure is 95.
Yes, sir.
Meaning a total of 95 will live over the 3 years. So times the fair value of the option at the grant date, which is 4 naira. So how much would that give us?
$564,000
Times what?
times 1/3.
So how much is that?
188,000.
So, sorry, I wanted to ask you a question. This exercise price, is it like the price when the employees want to buy the shares, they are allowed to buy it at that price. So it's not even relating to like what we are doing here.
Yes, it's not related to it at all.
Okay. Thank you,
It's
sir.
not related to it at all. Then in 2002, they said 2002, and the entity estimate of total departure was revised down to 70. So how many people, what's the estimate that will not leave?
That's 200 minus 7. 800 minus 70. That's 730.
Okay. Times 4 naira. So what's the total?
584,000.
So times 2/3. How much is that?
And sorry, 389,333.
No. You sure?
Yes, 2/3. Yes. 5. Let me do it again.
Yes, sir.
389,333.
Yes, 389,333.
Okay. So what do we have?
201333.
201.
333.
2001. Okay. How many left? None. So how many employees are now remaining?
It's just 800 minus 40. That's 760.
How about this 20?
Ah, okay, sorry.
740.
800 minus 40 minus 20.
Yeah. So 200 times 800 minus 40 minus 20 minus 4. So how much is that?
592,000. 592,000 times
Okay.
3.
How much goes to
592,000.
So 592 minus 389,333. How much is that?
202,667.
Okay. Now, the examiner didn't want us to stop there. They also want us to show the share issue, that people that exercise their rights, how are we going to account for the share issue? What's double entry for it? So all I need is the exercise price, which is 1.5. Because the employees will need to pay 1.5. They need to pay 1.5. And when they are paying, mean that the company is going to receive money. So with that, are we going to debit bank or credit bank?
Debit bank.
So debit bank. So we are receiving money from how many employees? 740 employees from here. Okay. And how much are we receiving from them? 1 naira 50 kobo. They're paying 1 naira 50 kobo. So how much is that?
222,000.
Sorry?
222,000.
222, sir.
Yes,
Two, two.
200. Two, two, two.
Okay. So now we have debited bank. So what do we do again?
You credit equity. They've exercised their right. So it's just equity with credit.
Which component of equity?
Uh,
Ordinary shares.
it's not ordinary shares, yes.
Okay. So credit share capital with how much?
With
With
the
200?
same amount.
No, not the same amount though. You cannot credit.
Nominal price.
Thank you very much, Shafa. Nominal price times one error. You cannot credit share capital with exercise price. It will be with nominal value. This one error. Only nominal value can go to share capital. So how much is that?
It's 148.
148,000.
148.
Yes.
So
Share
after
premium.
that, what are we doing?
Share premium. Share
Share
premium.
premium.
How much?
74,000.
148.
Hmm?
74,000.
How did you
74,000.
get that?
Um, I did
200
2 to
times
2 minus
7% times
148.
0.50.
No, no, no. You cannot do something 0.50. Even if for anything,
200. Okay.
is the difference between the market price and the nominal value that goes to share premium, not exercise price and nominal value. And were we given the market price at
Oh,
the end at the exercise date? We're not given. We're not given. We don't have it. So we cannot get this share premium as a standalone. We can only get it as a balancing figure.
okay.
So that means there's something missing that we have not done here. The balance, the cumulative balance here in the equity reserve, what do you want to do with it? You cancel it out now. It's a credit. You take it out. It's no more. You know you are giving them shares. So you need to take it out. So by the time you add these two and deduct this credit, you will get one dangerous figure like this. Give it to me.
Ah, 666. 666,000.
Yeah, that's how it works.
So I'm very sorry. Please can you explain this 592?
So this equity reserve, so ordinarily, you know that this is a promise that we have been making to them that will give them shares that we're going to put in reserve. Now, the date has come. In fact, the first thing you should even do is to debit this reserve first. That's the first thing, to take it. That's what you are taking to share capital. But just that in addition to this reserve, they are also paying. So this is what we are collecting from them. The reserve and the money they are paying in exchange for shares. Just that what goes to share capital is nominal value. Whatever excess goes to premium. Okay? So this is what we are getting from them. This is what we are giving to them.
Thank you so much.
This is a very simple topic, and at the same time, it can confuse you. We are going to finish it up next week, Tuesday or Wednesday. That's when I'll finish it up with you. I will send you like 6 or 7 questions for you to practice a lot of questions. So you see that every other one, that's all. If you can practice this, the one that is cash settled is not different from what we have done. It's just few difference, which I will show you with this question. This is the first question I will solve with you next week. And as soon as I solve this question, I will go straight to deferred tax implication of share-based payment. I will go straight to that, then hopefully finish it. Then we'll really be done with this. But I'll send you like 7 questions, past questions inclusive, for you to practice all of these, calculating all these equity reserve, staff cost, and all of that. Please do it. The last assignment I gave you on IFRS 15, only 2 people submitted. Just 2 people. Financial return inclusive. And a new student. The person just joined us. That last class was his first class. So that student is showing huge potential. I will share the solution with them. Just I have not, I was still on my way from work. So I'll share the solution with them. They can revise it. The remaining of you, please do it. And this is your notes now. I think I will help you arrange it properly. It's arranged ordinarily because it's topic by topic. You follow one another. So you need to be following almost immediately with this note that I'm sharing with you. It helps you. So I would share the assignments along with the notes with you. So at the end of where we stopped today, you will see all the questions. So try to solve it so that when we are coming on Tuesday, you won't have any problem with this topic. You'll have learned it. I say you have any challenges, don't even wait till next week and reach out to me. I'll eventually answer you, explain to you and all of that. Okay, so let's do it that way. I'll see you guys. Those of you doing case study, I'll see you tomorrow evening. Those of you, and on Sunday, we are going to be finishing up with the foundation part of group account. As soon as I'm done with this topic, I'm moving to advanced part of group accounts with you, where we'll be looking at complex group, piecemeal acquisition, foreign subsidiary, disposal of equity interest. We'll look at all of that. Hopefully, all things being equal, we should finish it in March. If you can achieve that, then you guys are good. April, we'll just be having fun. We'll have very little to cover because we'll have covered the major parts. As soon as I'm done with that, it's like we are done with like 80% or 90% of our syllabus. Of course, sustainability reporting is still there. That's 10% that we have not touched. So I'll see how we can squeeze that in one of these days before the end of March. By the end of March, we should be over 80%. And what has really helped you guys is that Sunday classes that we are having. It is really helping you. So I think it's something we should actually continue. We'll have finished almost everything, sir, by the end of March. We'll have very little. So you guys will have a lot of time for revision. We'll finish our class early. You can then be using your free time to read. And please don't joke with these notes that I'm writing on the board for you. It's very important. You can easily use it to revise a topic. Then you can concentrate more on past corrections rather than reading a lot of things that will not be relevant to you at the end of the day. This is exam focused. Thank you, guys. Expect the assignments. Bye.
Hey, hello, sir. Please, I have a question.
Yeah.
Sorry, I should have raised up my hand.
Okay.
Sir, please,
Okay.
so I just want to confirm something. You know, you mentioned that whenever we see estimate at the beginning, that we should disregard it, right? We should just
Yeah,
focus
yeah,
on the estimate at the end. Are there
that's correct.
possibilities that they would give us estimate at the beginning without them giving us estimate at the end? And in
No,
such cases, we should be okay. No problem.
they won't.
Thank you, sir.
Yeah.